Welcome everyone. Thanks for joining us today for this presentation. My name is Doug Nakajima, and together with Mark Chaves, we are the co-leaders of Marcum's International Tax Group. As such, we've been responding to the opportunities presented by the international provisions of the Tax Cuts and Jobs Act. And actually, before we get into it, I'd like to start our presentation with just a look back at the challenges that were faced by Congress in addressing the international tax reform provisions. For at least the last 3 or 4 presidential cycles, there's been campaign rhetoric followed by administration words and actions that have portrayed international business in a distinctly negative light. And this perception that has been created, real or not, is that the U.S. tax system encourages and rewards companies moving operations out of the U.S. and thereby taking American jobs out and American tax revenues to low-cost and low-tax countries. And this created the view that U.S. multinational companies are not paying their share of U.S. taxes, and moreover, this has contributed to higher taxes on middle and working-class families. So what we have seen, I'm trying to move the slides, there we go. The Act's major international components respond directly to these perceived concerns and seek to achieve the objectives of one, making the U.S. more competitive globally, and a prime focus of reducing the corporate rate to 21%, and seeking to increase U.S. as a site for foreign investment. Second, leveling the playing field. This objective is basically trying to level the incentives for U.S. and foreign business and all the provisions that have been put in place to try to curtail U.S. companies moving offshore. And then finally, stopping the erosion of the U.S. tax base, that is moving taxable income outside the U.S. and trying to shield it from U.S. tax. And finally, certainly one of the major headlines was the fact that we had U.S. companies that had trillions of dollars of untaxed foreign profits that they were holding offshore, not bringing back. And so by these provisions, we are looking to inject cash back into the U.S. economy for either growth or infrastructure investment, enhancing shareholder value, and as we've seen from some companies pretty recently, to increase worker compensation. So, all told, as a result, we're now faced with significant international changes in the methods that have been chosen to achieve these objectives. And so I'd like to turn this over to Mark to begin with the provision that requires the most immediate attention.
Thanks, Doug. Welcome, everybody. This is Mark Chaves. As Doug said, one of the co-leaders of the international tax practice. And I'll start off today's presentation with the transition tax. This tax really is one of the most impactful provisions of the Reform Act and potentially could be one of the most immediate. As you'll see when I go through the presentation, this can potentially impact 2017 tax returns for U.S. taxpayers. Now, on a high level, the transition tax looks to treat as repatriated any earnings of certain foreign corporations that are owned by U.S. shareholders, whether or not any of those funds have been distributed back to the United States shareholder. And the option is under these provisions, the shareholders would have to pick up the income as a deemed dividend, but the trade-off is that the effective tax rate on this income inclusion is going to be lower than it normally would have been. So what types of corporations do these provisions apply to? The scope it applies with respect to any specified foreign corporation. A specified foreign corporation is a controlled foreign corporation, which means that the entity is more than 50% controlled by U.S. shareholders, or it may apply to a foreign corporation that is not necessarily greater than 50% U.S. controlled, but for which there is a U.S. shareholder that owns more than 10% of the ownership interest in the foreign corporation. Either of those two types of entities are treated as specified foreign corporations and may give rise to a deemed dividend inclusion. In computing the transition tax, you need to identify if you have any types of specified foreign corporations that you're invested in, and secondly, determine what their earnings and profits attributable to tax years beginning after 1986, to the extent that those earnings and profits have not been subject to U.S. tax as yet. For example, many foreign corporations are engaged in the U.S. trade or business and actually have, accumulated earnings that are considered to be ECI, which is effectively connected with a trade or business, in which case that block of earnings would not be subject to these provisions. In addition, foreign corporations may have been affected by our existing anti-deferral rules, which generally require that certain types of income is immediately taxed to U.S. shareholders, whether or not distributed. And these rules have been in place for a while. So to the extent that the foreign entity is subject to those provisions and some of the earnings have been already subject to U.S. tax, then that block of earnings would not be included in the transition tax provisions. Now, if there are multiple foreign entities involved, the situation becomes a little more complex because some entities may have earnings and profits deficits and some may have positive earnings. Under these rules, you look to the aggregate. So to the extent that you are an investor in a foreign entity that has a deficit in earnings, those deficits can be applied to the positive earnings of other entities to reduce the net impact. Now, it gets quite complicated if there are multiple entities with different levels of shareholder ownership by the same people or the same person, because then you really need to go through the exercise of computing what is your share of this aggregate amount. The earnings and profits amount are measured as of two distinct dates. One is November 2nd, 2017, and the other is December 31st, 2017. So essentially, in doing the computations, you would need to determine the earnings and profits balances on each of those dates, and pick the inclusion amount will be based on the greater of the two. To the extent that the foreign entity has actually made distributions during the year, those distributions would not be counted. So in effect, it would be added back in computing the earnings and profits amount. Importantly, this applies for taxable years beginning before January 1st, 2018. So if, say, you're a calendar year taxpayer and your foreign entity reports on a calendar year basis, then the measurement date the income inclusion would result in 2017, which obviously is an immediate impact. But to the extent that your fiscal year, or the foreign entity reports on a fiscal year as well, so let's say, for example, it's a June 30th year end that began July 1st, 2017 and ended June 30th, 2018. In that example, the applicable year end, or the measurement date for pickup inclusion would be the June 30th, 2018 year. Mechanically speaking, once you have identified that, you identify the foreign entities that could give rise to this inclusion, and you have determined what your earnings and profits balances are going to be, we then need to look at the aggregate balance sheet of the foreign entities, because depending on the makeup of that balance sheet, that will drive what the effective rate on this income inclusion is going to be. So, for example, if all the entities in the aggregate are in a foreign cash position, you would need first to identify what the cash balances are, and to the extent that the earnings to be picked up are attributable to cash, then those earnings would be taxed at a rate of 15.5%. To the extent that the earnings are attributable to illiquid assets, then the illiquid component would be subject to tax at 8%. And we're going to go over an example shortly. What constitutes cash for purposes of these provisions? Obviously, cash is to be counted, as well as accounts receivable net. So you'd be able to net the accounts receivable and accounts payable of foreign entities. CDs, foreign currency, short-term obligations, and marketable securities generally fall within the definition of cash. Now, in determining this aggregate cash position, there are also some dates that are relevant. So going back to my example of a calendar year taxpayer, we would need to evaluate what is the cash position as of either December 31st, 2017, or the average of the 2 prior tax years that ends before November 2nd, 2017. So in this case, we would compare our cash balances as of December 31st, 2017 with the average cash position as of December 31st, 2016 and December 31st, 2015. So the sum of those two divided by 2, you compare to your December 31st, 2017 date, and your cash inclusion would be the greater of those two amounts. Including the transition tax liability, foreign tax credits may be applied. So in most cases, the foreign entity likely paid income taxes in their jurisdiction if they're in a positive earnings position. If you're a corporate shareholder and you're faced with picking up this deemed dividend inclusion, corporations are allowed to take a deemed paid credit, which means that a corporation can take a foreign tax credit for taxes actually paid by the foreign entity that is producing this dividend. So in this case, if you're a corporate shareholder and you're faced with this deemed dividend amount, and the foreign entity has actually paid taxes on the earnings that are going to be picked up, part of your transition tax liability can be sheltered by these deemed paid credits. Now, keep in mind that the dividend, or this deemed dividend, is being taxed at effectively a lower rate than it would have been taxed, had these provisions not applied. So as a result, any foreign tax credits that are going to be utilized to offset this tax is also going to be correspondingly reduced. One significant element is once you've computed your transition tax liability, you have the option to elect to pay that liability over 8 years. And under these rules, you would pay for the first 5 years, 8% of the liability. In year 6, you would pay 15%, year 7, 20%, and year 8, 25%. The election, in the case of a 2017 calendar year, the first installment would need to be paid by April 15th, 2018. So obviously there is some immediacy in computing and figuring out the exposure under these provisions. There are certain rules with respect to S corporations and real estate investment trusts. Particularly, S corporations may elect to defer the application of this transition tax until a triggering event occurs. A triggering event is defined as the S corporation ceases to be an S corporation, there's a liquidation of its assets or disposition of substantially all of its assets, or there's actually a transfer of stock of the S-Corp. So S-Corp shareholders of foreign entities obviously have a lot more flexibility in carrying out these provisions than non-S-Corp shareholders. Another significant element is an election to preserve the use of net operating losses. This is important because this deemed inclusion that results under this transition tax provision can actually be sheltered by existing net operating losses if the shareholder has some. Now, the rules provide that the shareholder can make an election to not use the existing losses against this transition tax income, and I'll walk through an example as to why that should be considered. We have an example. In this case, we have a controlled foreign corporation that has earnings and profits balances of $3 million. So we've determined that this is the greater of the earnings and profits balance that needs to be included. After examining the balance sheet of the foreign entity, we've determined that there's cash and cash equivalents of $2 million, and the remainder of the earnings are attributable to illiquid assets, which equal $1 million. Illiquid assets could be, fixed assets and other items that are not counted as cash. Assume for simplicity that the foreign entity has not paid taxes with respect to this $3 million of earnings. Computationally, we would then take our cash inclusion amount, in this example, $2 million. We're allowed a statutorily determined exemption percentage in the case of a cash inclusion, or in case of an earnings and profits inclusion attributable to cash. That exemption percentage is 0.557, and this is actually in the statutes. In this case, it would result in a net inclusion of $886,000. Since it's a corporate entity, the highest corporate tax rate for 2017 would be 35%, resulting in a tax amount of $310,000. If you take $310,000 divided into the $2 million cash inclusion, you'll see that the effective rate is 15.5%. So mechanically, in order to arrive at the 15.5% rate, to compute the inclusion amount and apply the actual percentage that is going to be excluded. It's not just a flat 15.5% rate on the included amount. Moving over to the illiquid portion, we have $1 million of earnings that are included. In this case, the statutorily determined exemption percentage is 0.771. The higher exemption amount in this case is because the effective rate on illiquid assets is designed to be lower. This would result in a net inclusion of $229,000, taxed at the same rate of 35%, puts us at an $80,000 tax liability. If you take the $80,000, divide by 1 million, you'll see, divided into the 1 million, you'll see that the effective rate on this block of earnings is 8%. In the example that the CFC had paid taxes on the $3 million of earnings that are being included here, then the liabilities computed here of $310,000 and $80,000 could be reduced by any deemed paid credits attributable to those taxes paid. Once again, the effect of those tax credits would be reduced correspondingly. So in the case of the cash inclusion, you would essentially lose, 55.7% of the tax credits that you ordinarily would have been entitled to, and the 77.1% for the illiquid assets. One important consideration that I think is really worth mentioning is the deemed paid credit, or the ability to take deemed paid credits, are useful for C corporations. So corporate shareholders of foreign entities can take a deemed paid credit. This is under, our law and has been around forever. However, individual shareholders or shareholders, of S corporations, and the S corporations may be shareholders of a foreign entity. If you're the ultimate individual shareholder that is not a C corp, is not entitled to take these deemed paid credits. So in this example, the inclusion amounts would be the same, the exemption percentages would be the same, but instead of a 35% corporate tax rate to be applied, if I'm an individual and I'm in the 39.6% tax bracket, then my tax liability on that income would be tabulated at 39.6. Now, if the foreign entity has actually paid foreign taxes on these earnings, I would not be eligible to take a deemed paid credit unless I make what's called a Section 962 election. Now, the 962 election has been around forever, and it's not very widely known and probably not widely invoked, but I imagine that it's going to become a lot more popular now. And under the 962 election, if a U.S. individual shareholder is faced with this deemed inclusion, the shareholder can actually make an election to be treated as a corporation for purposes of this computation. This would then allow the individual to be taxed on this inclusion at 35%, and more importantly, to the extent that there are foreign earnings or foreign taxes paid on these earnings, the individual would then be able to take a deemed paid foreign tax credit. So if you're an individual and you're faced with this transition tax liability, certainly the analysis of whether a 962 election would be beneficial is important. Final example is with respect to net operating loss usage. As I mentioned a short while ago, these provisions allow for shareholders to either apply existing losses to offset this deemed income pickup, or an individual may elect to not use NOLs against this income pickup and preserve the losses for future years. So going back to the example that we had, assume the same cash inclusion amount of $2 million, the same illiquid inclusion amount of $1 million, the same percentages would apply. That does not change. So now we have a total inclusion of $886 with respect to cash, plus $229 with respect to the illiquid portion, for a total inclusion of $1,115,000. If the NOL is not used, meaning that the taxpayer chooses not to apply the NOL against this income, then the tax can be tabulated and paid over 8 installments, as I described earlier. The NOL would then be available to be used in, say, 2018 to offset any income that the shareholder may have in 2018. So if the shareholder is in the 37% tax bracket in 2018, this NOL can then shelter that income. Alternatively, if the NOL is actually used in 2017 to offset this tax liability, there would be no transition tax to pay conceptually, because the income has been sheltered by the NOL that is existing. However, in the subsequent year, in 2018, if the taxpayer is in an income position, that NOL would no longer be available to offset it, And assuming that the shareholder is in a 37% tax bracket, then there would be tax due on that 37% on that income, and the due date on that is much more immediate than a 8-year installment plan. So if you're in a position where you have NOLs and you're faced with this transition tax exposure, it does make sense to analyze whether or not you think the NOLs can be used, what your future income position is going to be in determining whether or not to elect to bypass the NOL or to utilize it. Finally, if you're a corporation, that decision is likely easier if you're a corporate shareholder, because as Doug had mentioned in the outset, and as we had mentioned in the previous installments of this series, the corporate rate has been reduced from 35% to 21%. So mathematically, it probably makes sense to use the NOL to offset income that's ultimately taxed at 35%, instead of not using that NOL and preserving it for future income that's going to be taxed at 21%. So I'm going to go ahead and turn it back over to Doug, and Doug will continue with some other provisions.
Okay, thanks, Mark. Obviously, this is a important area for everybody to determine, as the transition tax is a 2017 event, as opposed to our next topic, which begins for years that begin after December 31st of 2017. So we're really talking 18 for this GILTI tax. I'm going to say that the act overall has been very much publicized in the press and by some commentators as moving the U.S. into a territorial taxing system. That is, one that looks to tax only U.S. sourced income. Well, not so much. This is not really accomplished by this act. It moves us towards the territorial with some of the provisions, and some of it we'll be talking about in a moment. But essentially, we are looking at some new taxes which actually take the opposite approach. Instead of protecting against base erosion from the U.S., it actually is base expansion, which is the case with our next topic. With the unfortunate acronym of, and maybe perhaps expected acronym of GILTI, this tax is essentially a new inclusion under Subpart F, and basically applies to all 10% U.S. shareholders of the CFC, and requires this gross income inclusion on an annual basis. So what is GILTI? It's very generally a deemed dividend, and very broadly again, it's generally the taxable income of the CFC after we allow an offset for a prescribed level of routine return on the CFC's tangible assets. That is what the IRS and Congress have determined to be what would be an expected level of return on your foreign investment, as opposed to attempting to shelter U.S. income abroad. Dropping down into the trees of this calculation, and we get hit with a bunch of new terms. But basically what GILTI is defined as is the excess of net CFC tested income over this net deemed tangible income return. So as you see there on the slide, essentially what we're going to do is take the gross income of the CFC and make certain offsets against it, including U.S. effectively connected income, Subpart F income, and allocable deductions, and some of the other categories you see there. From that, what we're going to do is look at the net deemed tangible income. This basically is the amount, essentially, of the depreciable assets sitting in the foreign company. And again, the expected return on that, as established by the Act, is 10%. So what we're going to do is take that 10% off of that net tested income. And maybe it's a little clearer if we look at it in this example. I think all of our examples say simple on them. I understand that may be far from the truth with some of these things. And on the determination of the net CFC tested income there in the second grouping. Essentially, we're going to take that $200 of tested gross income, and that is the income of the CFC exclusive of the subpart F piece of it. Obviously, that's, again, one of the adjustments out of it. And then we're going to take our allocable piece of the total deductions of the CFC and the foreign taxes paid to get down to this CFC tested income amount of $90. Under the example, we have qualified business asset investment of $200, and that 10% level of that is $20. And so basically offsetting that tangible routine return of 20 against the 90, that gives us our GILTI inclusion of $70. So where do we go with that? Individual shareholders, you're done. Basically, they are taxed at the GILTI inclusion at ordinary income rates, which will be 37% in 18 and forward. There is no foreign tax credit, and obviously no Section 78 gross up on that amount. That basically carries with it the cautionary advice that we need to be wary of phantom income. That is, we're going to get taxed on an inclusion into our current taxable income as an individual, but we may actually get no distribution to pay the tax that is generating. So that needs to be looked at, and obviously it's a matter of discussion with the foreign company to make sure that at least we can cover our tax liability on that. For corporate shareholders, however, this is just the first of many instances here where there is this divergence between individual tax treatment and corporate tax treatment under these international provisions. First, the U.S. corporate shareholder of the foreign company is allowed to take a deemed paid tax credit. And so that basically what we are allowed to do is take a foreign tax credit for foreign taxes that are attributable to this GILTI portion. Therefore, we need to come up with an inclusion percentage, which is really GILTI income over the net taxable income of the CFC, and multiply that times the taxes. That is what then is available to us for use in the foreign tax credit computation. The only, limitation on that was placed on by the Act is that they're not going to give you that full amount. They're going to haircut it by 20%, and so the 80% of that amount of foreign taxes that are attributable to the GILTI net income is then available as a foreign tax credit. Once again, example, hopefully this one makes it a little bit more visible. So we have the GILTI net income that we determined in that first computation of $70, and we take that over the full net income of the CFC at 180, and our inclusion percentage is 38.89. We know that under our example that we pay $20 of foreign taxes, so that what our gross up would be on that amount is going to be $7.80. One of the things that is a quirk under this provision for the deemed paid credit and the GILTI is that Section 78 gross up is done on the full amount of the GILTI inclusion, and that's $70. It's not limited or otherwise by that same 20% haircut we're taking for the use of the deemed paid foreign tax credits that we'll actually take, so that basically our gross up is greater than the amount of the credit we have available to us. One more step, one more variance between corporations owning the foreign company and an individual owning that foreign company. Now what we're looking at is a deduction for a corporate shareholder of that company equal to 50% of the GILTI inclusion. So obviously this is a significant divergence from an individual who has to pick up the 37% on the 100% of the GILTI amount as computed. So what we take here is not only the amount of the GILTI inclusion, but also the amount of the gross up, and basically take a 50% deduction on that in making our computation of taxable income. Again, here we have the GILTI inclusion of the $70 plus the gross up of $780. So we have 77.8 in our GILTI inclusion. Half of that becomes a deduction, which is going to then result in our net GILTI inclusion for the corporate shareholder, which is going to be taxed at 21%. And against that, we are able to take that foreign tax credit, albeit haircut by the down to the 80% level, and get with what our net increase is in U.S. tax for that GILTI inclusion. And again, as we continue on with some of these distinctions with respect to the individual and corporate ownership of the foreign companies. Here again, what we have is a corporate owner of a foreign company, and basically this foreign-derived intangible income is going to allow us to essentially lower the U.S. rate on a piece of this foreign income that is defined as the intangible income through the calculation as defined, which we're going to go through here. But essentially what it does is give us, on that computed amount, 37.5% as an additional deduction on that. So essentially, with respect to foreign-derived intangible income, we're left with an effective rate now down to 13.125. Just one other point as an aside, and obviously not an immediate impact on us, but after 2025, part of the adjusting mechanisms that have been put in place with the Act to worry about the ability to be balanced after 2025 is that some of the rates are going to go down, and this 37.5% deduction here for the foreign-derived intangible income deduction will lower down to 21.875, and so that again we'll get haircut down to that level in 2026. That again obviously assumes that we don't have other changes that we are going to need to address in the coming years as we get a little bit more experience with these provisions and what Congress decides to do. Just kind of backtracking here, that reduced rate that's achieved by the 37.5% deduction is basically, again, starting with gross income, reducing out these items you see on the slide there to come down after, again, reducing out the same 10% level of tangible income to come out with what is known as deemed intangible income, and that's what is going to be available for the deduction. So again, quite a few distinctions between individual and corporate ownership of the foreign operation, and as can be seen in the results on this example that we have, is that essentially what you're going to have because of the direct taxation on pass-throughs and the unavailability of some of these deductions is the foreign-derived and intangible income deduction, is that the pass-through income is going to be taxed at 37% in full, as opposed to looking at what a C corporation will face in terms of their tax liability. And even with bringing it, through the C corporation and having to suffer that additional level of tax on the distribution out of the C corporation, we're going to come out with a lower tax coming through the corporation. What does this mean? This means that as a baseline, what individual shareholders of foreign corporations should be looking at is the kind of cost benefit and the various implications would be of moving from individual ownership of the foreign corporation to corporate ownership, U.S. corporate ownership. So inserting a U.S. corporation into the ownership chain. There's not a general rule on this. We obviously see some of the distinctions in terms of the tax liability that is generated by the distinction that's there under the Act. But in terms of looking at the potential benefits to be derived by corporate U.S. ownership of the foreign operation, that's something that really everybody should be looking at. I'm going to come to this, and I guess with apologies, I think Mark and I, when we were looking at trying to organize the slides, we essentially buried the lead here. In terms of looking at, going back to, again, to that goal of moving towards a more territorial system, the rest of the world has employed for quite some time what's known as a participation exemption, which allows dividends to be paid up to a parent operation without suffering a level of tax at the parent level. This is kind of the major complaint that was voiced by some of the major corporate leaders to Congress in the hearings and looking at the vast wealth that they are holding offshore, and then the fact is that they didn't want to bring it back, and certainly we're not going to bring it back at 35%. And so that as they looked at it, short of the transition tax hit that they're going to have up front, part of the offset, the positive offset to that transition tax that people were going to be suffering, albeit with the benefit of bringing the cash in, is the fact that on a go-forward basis, shareholders in 10% owned foreign corporations are going to be able to bring that money back with essentially 100% dividends received deduction. So you can get it back to the United States with no additional tax at that level. Now, you're going to have to still look at, see what is going to occur when you take it out of the U.S., but come out of the U.S. corporate solution and to the individual shareholders. But bringing it up to the U.S. level, that now for these corporate holders, again, corporate holders of these foreign corporations will be allowed to come in without tax. Individuals, again, not so much. They are still going to be taxed. So that with respect to the corporate shareholders, however, they're going to be able to bring it in tax-free. There is obviously, because they're giving you that exemption, there are no foreign tax credits that are allowed with respect to that. And again, this is for distributions made after 2017. So again, this is part of the movement towards territorial. We're not there yet. There's some other exceptions, and I think our last topic is one of those exceptions, so I'll turn it back to Mark.
Thanks, Doug. Our last provision here, and I'm not going to spend an inordinate amount of time on it, but at least enough for folks to know that it's out there. The last provision here that we're covering today is called the Base Erosion and Anti-Abuse Tax, more affectionately known as the BEAT tax. So what this is designed to do is to really discourage U.S. corporate taxpayers from making deductible payments to foreign-related parties. So to the extent that you have a U.S. entity that is a qualifying U.S. entity, and we'll get into that description in a bit, if that entity makes a payment of, say, a service fee, a royalty, or other deductible type payments, and these provisions apply, there's going to be essentially a minimum tax to be imposed on it. Payments that qualify are could be royalties, service payments, any deductible, other deductible type payments, as well as acquisitions of property that would be depreciated here in the U.S. So if you're buying property from a foreign-related party and you're the type of entity that qualifies under this BEAT provision, then there would be a BEAT tax to pay. So what types of entities would fall within this BEAT purview? A, it must be a C corporation. Secondly, so an S corporation would not apply. Secondly, the gross receipts of the U.S. entity has to be at least $500 million. Now, that $500 million test is a 3-year average test. You would look at the gross receipts for the 3 previous years, prior to the year that you're being tested. To the extent that that average it exceeds $500 million, then that entity is one that would fall within the BEAT purview. Third is these BEAT deductions have to be at least 3% of the U.S. group's total deductions. Computationally, the BEAT amount is equal to 10% of what's called modified taxable income over what modified regular tax liability would be. This amount changes for 2018 to 5% and 12.5% for 2026 and later. If you're in the banking business, you pay an additional 1% if these provisions apply. So essentially, the BEAT tax is really an alternative minimum tax for corporations to pay. So if you're making significant deductible payments and computationally you add back these payments to your taxable income and apply this 10% rule, you could have a BEAT issue. Modified taxable income is really the taxable income of the group, but you need to add back these deductible items or related party payments that actually reduced the taxable income number. So in this case, it would be could be service payments, royalties, interest expense. You would also need to add back depreciation as well. There's a provision here saying that you would need to add back payments that reduce gross receipts. That is essentially means cost of goods sold type payments, but this would only apply if the foreign entity that is receiving the payment is what's called an inverted company or used to be a domestic entity. Otherwise, cost of goods sold type payments are generally not not included as a BEAT issue. BEAT payments, certain derivative payments don't apply. Payments that reduce gross receipts, as I mentioned, cost of goods sold payments would not be a BEAT deduction. Certain expenses and services costs that are enumerated under our transfer pricing regulations. And finally, payments that are already subject to U.S. withholding tax. So the rationale is if you're a U.S. entity or if the U.S. entity is making a payment to a foreign-related party and there's already U.S. withholding tax on it, so in the case of royalty payment to an entity that we don't have a treaty with, and the U.S. is taking a withholding tax on it, then there would be no further BEAT tax to be paid. In computing the regular tax liability, you start with the tax liability of the domestic entity, and you subtract out, certain credits, and up to and including foreign tax credits. So once you have identified what the modified taxable income of the U.S. entity is and applied your 10% potential BEAT number to that, 10 to that modified taxable income, you now compare that number to what this recomputed tax liability is, and to the extent that your 10% of modified taxable income is higher, then the BEAT provisions would kick in and you would pay the excess. That's it for the presentation part. I appreciate you guys taking the time, and we're going to now take a few minutes to address any questions.
Gentlemen, this is Erica. I sent you each an email with the questions that we've received so far.
Okay, so one question says, is a 962 election that is allowed for individuals for the transition tax also allowed to be made for the GILTI tax? That's actually a very good question, and the answer to that is yes. However, you know, there's a technical aspect of this which says that, you know, as Doug went through in computing the GILTI tax, there was the GILTI inclusion, there was the inclusion amount, and then there's, for corporate shareholders, a 50% deduction. If you make a 962 election as a shareholder, we're not entirely sure if this 50% deduction would actually apply, but conceptually speaking, a GILTI inclusion is the type of income that would lend itself to a 962 election. Second is, how is the exemption percentage determined? This was just based on the statutory amounts that were allowed. So the exemption percentage with respect to cash was actually determined such that when you apply the highest corporate rate, or once you apply a 35% rate to the net amount after the exemption, that the effective rate would turn out to be 15.5%. And the exemption amount of 0.771 related to illiquid asset inclusions, that amount was specifically determined to result in an effective rate of 8% once you apply the 35% rate to the net amount. But if a U.S. shareholder uses a calendar year and a specified foreign corp uses a fiscal year, can you end up with a situation where a U.S. corporation may have or have to calculate if it has a transition tax for its 2017 year and a tax year beginning in 2018? Well, conceptually, if the foreign corp has a tax year that ends after 2017, December 31st, 2017, then the shareholder pickup would be determined based on that foreign entity's year end. So really, you'd have to look at the year end that the foreign entity has and that year end as it intersects with the U.S. shareholder's natural year end. I don't believe there are any more questions, so I'll turn it back over to Erica, and I appreciate everyone's time.
Mark and Douglas, I actually just linked you 2 more questions that came up in the last few moments.
Okay, we'll take a look.
While the gentlemen take a look at that question, I'd like to let everyone know that in the next few days, our marketing group will be sending out an email with a copy of the presentation slides from today, along with a link to view the recording of today's session in case you would like to review anything that you saw today.
Question on the BEAT deduction: if payments are subject to U.S. withholding tax but is reduced by treaty, is the payment still not considered a BEAT deductible payment? I'm not sure. I think well, I'll come back to you on that, but conceptually speaking, if there's any withholding tax on the payment, even if it's allowed by treaty, then that should disqualify it from being a BEAT payment.
I agree, Mark, and I think that the overall, I guess, caution that we would give here is obviously there is a definite minimal amount of guidance that is out there. IRS is doing their best to try to get out notices to to provide guidance on a lot of these provisions. They are obviously lagging significantly behind on that, and so that as some of these things become more clear, we'll be getting some more notices out here from Marcum. I think that the issue with respect to a lot of these provisions and the interaction of the two basically fell to the wayside as they were attempting to push this legislation through before Christmas. So again, there is a lot of uncertainty out there. There is certainly a lot of questions that are out there, and also misinformation that is out there with respect to a lot of items. So as we continue to advise, this is something that continues to require monitoring and checking back to see whether or not guidance has been issued with respect to some of them.
Okay, another question came in. Says for Section 965, dividend received deduction, earnings and profits tax, is it only for 2017, and after 2017 will be subject to GILTI and FDII tax calculation? That is exactly right. The actual transition tax and deemed inclusion is a one-time tax that is applicable to accumulated profits. Let's use a calendar year example that are in existence as of 12/31/17 or November 2nd, 17. On a go-forward basis for 2018 and forward, then you're now subject to the GILTI and FDII provisions, which, as Doug mentioned, could result in immediate income pickup. And obviously, we need to explore whether or not having, a domestic corporation as the owner of a foreign entity would now make sense, considering that, this GILTI provisions are a lot more favorable for U.S. corporate shareholders than U.S. individual shareholders.